is she's got a wonderful visibility on the challenges individual investors are having in bonds. Kathy Jones, where did the 60-40 portfolio go?
Yeah, a lot of people have tried to abandon it in hopes of getting more income, getting more safety, getting more diversification. But I really don't think it's disappeared entirely. I think it just has to be more nuanced on the fixed income side. So if you look at rolling correlations over the last 6 months or 5 years, you're still getting diversification from treasuries and higher quality bonds. It's just the upside is much more limited, and the magnitude of those changes is much smaller.
What's the elasticity on the downside? If we get yield up and price down, what could be the magnitude of that price down?
Yeah, I'm looking at, if I look at the 10-year Treasury and we get a move up in yield this year or into next year, I'd say maybe 95 basis points to 1%. I don't think we get much more than that on the upside. On the downside, you might get down to about 45 basis points or so, or even less, I suppose, in a real negative scenario. So it isn't the kind of move you used to see 6 to 10 basis points a day on a big down day in treasuries. I mean, in the stock market, you're not seeing that in treasuries now. It's a much more limited move.
In fact, yields higher in the last 24 hours by a basis point with a 2-3% move in the equity market. Kathy, so many people in stocks have been queuing off what's happened with real yields. Can you just unpack that for us a little bit, what you're seeing at the moment?
Yeah, the Fed is holding nominal rates very steady between their zero policy, their forward guidance that it's going to stay there for a long time. And what we've seen, though, as inflation expectations come up, so the real yield has come down to about negative 1% on the 10-year Treasury. And that gives you very limited choices in terms of where you invest your money in the fixed income market. But it does work for the Fed because it makes the hurdle rate for investments very low. It encourages people to borrow, spend, and invest. And that's really what the Fed is trying to get the economy to do.
The rate side of the story anchored. I'm just wondering, Kathy, I'm trying to work out where you think inflation expectations are going to turn and whether we could actually see real yields get less negative because inflation expectations come in, given what we're seeing worldwide at the moment. Any thoughts on that, how things are developing, Kathy?
Yeah, my biggest fear in the U.S., and now it extends to Europe because of another round of outbreaks of the coronavirus, my biggest concern is we don't get fiscal stimulus, the economy slows down again. Worst case scenario is a double-dip recession. It's not our base case, but it's a worst case scenario, particularly if we would start to see a resurgence in virus cases here as well. So I think we're walking a fine line right now. Our base case is still for continued improvement in the economy, but without the fiscal stimulus, and if we were to see more virus cases, we could double dip into a recession in the next 6 months or so.
What's the playbook? What's the haven in that scenario if there isn't that much lower the 10-year yields can go? It used to be investment grade credit, and yet we've seen outflows and a little bit of underperformance there. What is it now?
Yeah, I still think it's treasuries. You're not going to get as much as you did in the past out of that trade, but it's still treasuries. And keep in mind, I guess in a very negative scenario, nominal yields can go negative at the long end. That probably would force the Fed to take much more aggressive action, but it's not without precedent. If you look at Europe, that's happened.
What about with riskier credit? We've seen some pretty big outflows from high-yield bond funds of late. Is this the beginning of a larger trend?
I think the market needs some correction in high yield. It's gotten very frothy. Some of the junkiest of the junk has rallied quite a bit. I don't think that we're going to see investors abandon it because you do get positive carry. You're going to get a yield that's, 5-6% in high yield, and that's tough to get. So I think you'll see people come back in, barring another recession. But it did get overdone. Spreads were very tight, and the lowest of the low started to do well.
You mentioned a couple questions ago, Kathy Jones, this idea of what the Fed wants, which is completely removed from the coupon given duration that the individual investor wants. We spoke with Richard Clarity yesterday. It was a complete class act. Great. But does he or the people around him, do they actually care about financial repression?
I would say no. I think they look at the policy of the Fed as being better for the greater good, and that's not going to change their policy. They think that savers and investors, although we hear a lot of complaints about low interest rates, they think savers and investors are benefiting from the rise in risk assets, and their focus is really on unemployment.
John Farrow, I think this is just an absolutely fundamental condition. We trot out in our fancy suits and ties and talk all this theoretic mumbo-jumbo while retirees and others are getting absolutely crushed well over a decade.
Kathy, this is really important, that these interest rates have been low for a long, long time, not just in the United States, but also in Europe. And the lower they've gone in places like Europe and Japan, they've never gone back up again. Kathy, do you worry about the same thing happening in America?
Yeah, one of the biggest fears we have is something like Japanification, where we get stuck in a deflationary or a very low inflationary environment, and there's not much more monetary policy can do. Again, it's not our base case scenario. We think that we're actually starting to see the economy do a little bit better. I'm relatively optimistic that we can get the virus under control, that it will continue to recover. But it is a worst case scenario, and you can't rule it out. I mean, there's a probability there. Maybe it's a low probability. Maybe it's 5 or 10%, but it exists.